And we're back for another exciting show this week with your host, Dawood Bedrastian. Yes, it's me. Every Saturday from 11 to 12, you're tuning to the show right here, Real Sense Now, where we give you the current condition and the opportunities and challenges that exist in our current market when it comes to real estate. We're here to analyze what's going on with the economy, cover some news articles, high-level overview about what's going on and how it starts to trickle down and affect you as the buyer or seller that is looking into entering into buying your next property, investment property, vacation home, or whatever the case may be. More importantly, we're here to show you how owning real estate is really the cheat code to your success, plus a whole lot more. So if you're tuning in for the first time, we're live every Saturday at 11 a.m. to 12. So right about now, most of the time when I'm interacting with people, just after they say, hey, how you doing? Hello, how's it going? It's usually followed by a series of questions that usually kind of goes something like this. Dawood, how's the market going? Are the prices going to go down anytime in the near future? When is a good time to invest? Should I be investing right now or should I be waiting it out? And you've probably heard me say the statement before. You're probably thinking, now has to be the worst time to be investing in anything, especially real estate. We've been experiencing some unprecedented economic disruptions in the recent years, and even more so in the last few weeks or so. And of course, there's this underlying fear of a possible recession that looks to continue into 2023. Mortgage interest rates are at record highs when you're looking at recent years, especially when we've been enjoying mortgage rates that were pretty much, a third or at half, depending on the time of year we've been talking about, to where they are today. We've seen significant layoffs on all the news headlines when it comes to the tech industries at legacy companies. We're talking about Google, Amazon, Meta. And of course, we've also seen a decrease in home sales due to high mortgage interest rates, with an additional 6.8% reduction expected in 2023. Some people are even saying a 15% shift in the market. So when you factor all of these points that I'm highlighting and you consider a looming recession laying ahead, it gives you a glimpse of what this upcoming downturn may look like. And as much as it may say, yeah, you know what, I'm right, I should wait it out, I definitely shouldn't jump into this market, I can also tell you that with all of these challenges come opportunities specifically for new businesses that are born and will be built under these circumstances. Counterintuitively, it's exactly these types of challenges that will actually create the perfect conditions for new opportunities to also be born and built. The best entrepreneurs are not intimidated in times of turmoil and will strive to capitalize on these opportunities as well too. And that's something that we definitely need to take note of. You see, entrepreneurs during these times know how to channel their fears and to respond to and even shape their future outcomes amidst this disruption. They are nonconformists, unafraid to question convention, and are always willing to try something new. We've previously had the guest that's on my show today, Mr. Rafi, on the show to discuss entrepreneurship and his nutrition and fitness business coaching in previous episodes. But today, I want to take a different turn. What most people don't know about Rafi is that he's a political analyst for over 15 years in Washington, D.C. And prior to becoming an entrepreneur, he's written over 200 articles published nationally and internationally, as well as numerous cable and radio show appearances. So even though he's not in the real estate field, we've invited Rafi today to tap into his analytical and well-informed mind to get a bird's eye view on the currently unsettled housing market and the interplay with recessionary fears, tech sector layoffs, bank failures, and the actions of the Federal Reserve to cool inflation. I know it's a lot to unpack, but today I want to start off with at least understanding what's been happening with the disruption that has occurred in the banking world. So just to give you a little bit of a history on what's happened, depositors have drained $126 billion from U.S. banks during the week ending March 22nd. According to the Federal Reserve data, that time the outflow came from the nation's largest banking institutes. 25 banks lost about $90 billion on a seasonally adjusted basis. The total industry deposits also fell to $17.3 trillion, down 4.4 from the same week a year ago. So new numbers reinforce some trends that were already existing in place. The deposits have been declining at all banks before the Silicon Valley failure, which have been falling each month for the first 2 months of this year, and deposits for all banks were also down 5% annually in the fourth quarter of 2022. Many observers attribute this nationwide shift to pressures being applied by aggressive Federal Reserve campaign to lower inflation, and some of that money has also been flowing into money market funds. Government and industry officials have been working to prevent massive deposit outlays in the aftermath of bank failures, and regulators have pledged to cover all depositors at both the banks that they've seized, hoping that they would calm any panic, and also promise to help other regional banks if needed. 11 giant banks also decided to provide one troubled regional lender, which is First Republic, with a $30 billion in uninsured deposits to stabilize the situation. Now, the challenge that the deposit outflows create for all banks is that they can raise rates on these deposits to keep customers. That could also help them to become less profitable. But then on the other hand, if they lose too many customers, as Silicon Valley Bank did, they'd actually give up critical funding that may force them to have to sell the assets at a loss to cover the withdrawals. Rafi, give us a background on what really happened with Silicon Valley Bank.
Dawood, first, thanks for having me back on the show again. It's always a pleasure to be here with you. So Silicon Valley Bank, a lot of people don't know, it was the 16th largest U.S. bank before its collapse. So it was a regional bank, but it was up there in terms of its size. It specialized in financing and banking for technology startup companies. In fact, it provided financing for about half of all U.S. venture-backed technology and healthcare companies. So it was very much invested in the technology sector and vice versa. Now, we recall the pandemic in 2020, these companies, tech companies, were flush with cash, right? Everybody was home and there was a lot of money being spent on technology during the pandemic while people stayed away from the office. Tech companies took this cash and deposited this cash with SVB for business expenses, such as payroll. And the bank invested much of these deposits, as banks typically do. Now, why did the collapse happen? Well, there's a bunch of reasons that can be kind of broken up into tangible and intangible reasons. Tangible reasons include a downturn in the tech industry post-pandemic and a lack of diversification by SVB Bank in terms of its deposits. And intangible, which is also extremely important, was customers' fears of bank insolvency, fresh in the mind still from 2008, where we had a major collapse of the banking system. So people were still that was fresh in their memories, and that also affected their view of SVB Bank's failure.
So bank runs are partly psychological, as you've alluded to right now. Can you elaborate on that a bit further as well too? Because I think in a lot of people's minds, they're afraid this is going to trickle down to many other banks, and we're going to start to see the same situation happen in 2008.
Absolutely. So in the golden days, if you had a fear that the bank was collapsing, you'd pick up the phone and you'd call your friend and you'd say, hey, did you hear such and such a bank is about to collapse? We should withdraw our funds. Well, take that type of communication and put it on steroids, right, with social media. In fact, a lot of people have referred to the SVB collapse as the first, and the bank run that followed, as the first Twitter and social media induced bank run, because this thing exploded on social media. amplifying snowball effect where people were now suddenly withdrawing their money or companies were withdrawing their money because other companies were withdrawing their money, and that kind of really started the stampede.
So who was affected by this collapse?
Two segments were affected. First, there were the depositors, both insured and uninsured. And it's important here to remind people that the Federal Reserve insures all deposits in any bank in the country up to $250,000. But beyond that, it doesn't. So you had people who had accounts that were insured under $250,000, and you had people who had accounts that were over $250,000 that were not insured. In fact, most of the accounts at SVB Bank, because they came from technology companies, were uninsured. And then you have the investors in the bank. So what the Fed came in and said, we are going to guarantee all deposits, not the investors, the deposits, both insured and uninsured, to try and stem the bank run and kill it in the crib, so to speak.
But how did the federal government prevent this larger spillover to happen to other banks? I mean, we know what they tried to do here. What has been their impact to stop the spillover to take place?
Well, they focused on Silicon Valley Bank and ensuring that there wasn't a snowball effect that carried over into other banks. Unfortunately, there was a little bit of a snowball effect with Signature Bank, but beyond Signature Bank, I think the bank run was pretty effectively, at this point, as of today, contained by federal actions.
It was also we also heard in the news about Credit Suisse as well too, and they just got UBS was agreed to buy them out as well too for, I think it was $3.25 billion or something or the other. It's great to see that we've learned our lessons from 2008, and both banks and governments are definitely, as you've mentioned, stepping in to ensure that we don't have the calamity that we experienced less than, 15 years ago or something or the other at this point in time. Do you think that is the position both our government and other governments around the world are going to be taking in order to stop these banks from collapsing worldwide?
Absolutely. There's a cliche saying that history repeats itself. Thankfully, this history wasn't that long ago in 2008. So it's still very fresh in the memory of governments that it's important to take quick and decisive action to prevent this from becoming a larger economic issue. And that's what happened both in the U.S. and in Switzerland.
And how could you say this collapse could affect small businesses and the financial sector in the near future?
Well, that's where sort of the intangible part kicks in, right? Small businesses, mortgage rates, and the housing market isn't directly affected by these bank collapses, but it is indirectly affected in terms of the uncertainty and the turmoil in the market that these bank collapses create. And with uncertainty comes hesitation, and with hesitation comes lack of dipping your toe in the pool, so to speak, of the housing market.
Well, we would definitely want to go and dive in a lot further as well too. So if you want to connect with me and have a real estate question, please visit my website at realsensenow.com. You can always catch me on any one of my social media platforms. That's Facebook, Instagram, or LinkedIn by just simply typing in my name, Dawood, D-A-W-O-O-D, and my last name, Bedrosian, B-E-D-R-O-S-I-A-N. Of course, you can always call us live right here on the air or text us at 321-339-1055 and get real-time responses. Remember, the real estate market, whether it goes up or down, always trends upwardly over time. Catch you after the break. It's your host, Dawood Bedrosian, and we're back with another episode of A Real Sense Now. I'm joined by my guest, Rafi Djani. We've been talking about the turmoil that some of these banks that we've been reading about in the news, Silver Valley Bank, just to name a few, have shut down, closed down, and a lot of people are worried and scared as to whether this trend is going to continue or not. I think the question on a lot of people's mind is your money safe in the bank moving forward? Rafi, what are your thoughts on that?
Well, I would hold off on putting your money under your mattress yet. Most experts do agree that your money is safe in the banks as long as you take certain precautions. So let's talk about these precautions. You should plan accordingly and stay within the FDIC insurance limits. Spread out your accounts as much as possible. Businesses and consumers should make sure all their deposits are insured. Another way is to have multiple accounts, is another way to ensure safety and to diversify your funds. For example, customers could have at least 2 bank accounts and 1 investment account to move money around. So there are ways to ensure as much as possible that your money is safe in the bank.
And what does this banking crisis mean for mortgage rates? Because these rates keep going up, and as these banks seem to be shutting down all the time, I think a lot of people are worried about what's going to happen with mortgage rates.
Well, there definitely has been a roller coaster ride for mortgage rates over the past year and a half. So after steadily rising in 2022, mostly due to the Federal Reserve raising interest rates to counter inflation, the average rate for a 30-year fixed-rate mortgage topped out at 7.08% in November of 2022. Then, with economic data suggesting inflation was retreating or cooling, the average rate dropped to 6.09% before rising half a percentage point in February of this year with renewed inflation concerns. So that's the roller coaster. The bank collapse in March sent rates falling again. On March 22nd, the Federal Reserve announced it would raise interest rates by a quarter point to fight inflation that was stubbornly holding on. But it also hinted that this may be the end of rate raises. As of yesterday, rates were at 6.17%. So you can see how it's gone up and down, influenced heavily by the actions of the Federal Reserve.
And do you think that a tighter credit will actually keep rates higher?
Well, it's tricky to answer that question. Typically speaking, mortgage rates tend to track the yield on 10-year U.S. Treasury bonds. Typically speaking, when Treasury yields go up, so do mortgage rates. When they go down, mortgage rates tend to follow. However, the fly in the ointment, so to speak, with the Treasury bond yields is tighter credit conditions. These conditions could offset the effect of Treasury bond yields, and bank failures will likely limit any dramatic plunging of mortgage rates. So, tighter credit conditions could restrict mortgage lenders' access to funding sources, resulting in higher rates.
On a longer term basis, I know you don't have a crystal ball, but are you expecting the rates to stabilize? Do you think that they're going to go down, or do you think that they're going to continue to rise?
That's a really interesting question, because I was doing some research before today's show, and I looked at 9 different mortgage rate predictions for 2023, all from very, very important and well-recognized sources. And the rates varied widely. They varied from a low of 5.25%, which was Bank of America, up to a high of 7.4%, which is Realtor.com. Now, these percentage changes may not mean a lot if we're talking about body fat, but when we're talking about mortgage rates, they definitely mean a lot. Just some other numbers. Morgan Stanley predicted 6% by the end of 2023. Freddie Mac, 6.4%. Goldman Sachs, 6.5%. The Mortgage Bankers Association, 5.3%. So you can see there's a lot of difference of opinion, expert opinion, on where mortgage rates will end up by the end of 2023.
And then in your good opinion, are we in a possible recession? Are we in a full-on recession, or are we still talking about a recession on the horizon?
I think we're definitely not in a full-on recession. I think we should avoid listening or getting all worked up by clickbait articles where people, I read an article the other day that said, "Are we heading towards a recession? ? Well, we are already in one! ! Well, we're not. The two of the key main indices that indicate there is a recession happening are unemployment and inflation. Obviously, inflation is high and remains stubbornly high, so that's one indicator of recession. However, the flip side is that unemployment is still even though it's increased a little bit, it's still at record lows. And when you have really low unemployment, but you have inflation, we are kind of in uncharted waters. And I don't think we're in a recession yet, although that may happen. I think unemployment here is important to watch very closely. The layoffs that you mentioned earlier in the show that's happening with these big legacy tech companies have been pretty much restricted to the technology sector. Now, if this spills over into the wider job market and we see unemployment rise, then we will definitely be in a recession. And I think that's the key thing to look at moving forward.
I think the unemployment rate, if I'm not mistaken, I definitely need to double check, is I think around 2.5%, if I'm not mistaken.
Yeah, it's in give or take in the 3% range. Yes.
Yeah, so that's significantly low. So I think that we're talking about 271,000 jobless Floridians out of a labor force of 10,761,000 people. Very insignificant, and it really kind of helps me to shift to the next subject matter that I want to get into. A lot of the people that I'm talking to are waiting for this great shift that's going to happen in the marketplace so that people can come and take advantage of purchases like they did in 2008. And I keep hearing, especially from a lot of international buyers, investors looking to invest in the Florida market. They're looking at a lot of key markets that they want to get in. And of course, Florida seems to always top the list. And they are anticipating or predicting the housing market to dip even further. And it seems that depending on what articles you read and what sources that news articles people are publishing, you're anticipating some kind of a shift in the market throughout the remainder of the year for prices to fall yet another 15% as interest rates start to squeeze out this housing market, right? Home prices are set to drop 15%, as I said, this year because the rates are remaining high, which helps to push down the affordability and the demand as a result of that. And some economists think that the housing market recovery would take place maybe towards the end of the year or the beginning of the next year, mostly in part because they don't believe that these mortgage rates are going to stay that low, or the couplet of it would be that there'd be so much pressure based on these rates being higher that sellers will be forced to lower their prices, which will allow for the opportunity to expand on people being able to buy a home at a reduced price, even if they're able to maintain a 6, 7, 8% interest rate at that point in time. Mortgage payments now are estimated to be around half of a home buyer's disposable income. And though payments only accounted for about 30 to 35% of a buyer's disposable income prior to the pandemic. So there's a lot of different factors at play here. Mortgage rates touched the 20-year high in 2022 and have stayed elevated, basically kind of crimping down this housing affordability and the demand that we've been talking about. As these rates start to creep up even higher, more and more buyers are waiting it out, and sellers that have enjoyed a 3% or the high 2 or even a low 4% interest rate are now reconsidering whether or not they actually want to put their home on the market. So ultimately, we still have a bit of a inventory crisis. Not half as bad as during the pandemic, but definitely not at pre-pandemic levels as well too. So ultimately, you're seeing homes that are staying on the market longer, but more importantly, you're also looking at not a lot of choice for a lot of buyers out there. Of course, the gem properties are the ones that are going to hit the market and fly off the shelves as quickly as possible. And I always advise my sellers when it comes to pricing your home, there's really only 3 things that one should consider when pricing a home. Number 1, it's the location of the home. We've heard the adage before, location, location, location. The second is the condition of the home. Has your home been renovated? Have you made any improvements? Does the home have a certain curb appeal that someone driving by will say, that's a beautiful looking home. That's the kind of home I would like to have. What's the landscaping look like? Is your kitchen improved? Is it decluttered? Does it appeal to someone that when they first walk into your property, they look at that house and they go, I can already see where my office is going to be, where the kids' rooms are going to be. This is definitely a place that I'm really enjoying. There's great energy in the room, and it's the home that I want to buy. I understand the prices may not be where I want them to be, but it's definitely a home that I definitely want to go in for. So despite the high mortgage interest rates, I believe that there's still a demand that far exceeds the housing supply. And there are signs that more home buyers are dipping back into the market. How do we know that? Mortgage applications have surged 3% in the last week, and pending sales have risen just under 1% in February, which was above the expected 2.3% decline that they had. And it's really interesting because there's actually another dynamic at play when it comes to buying. And I'm going to ask you this question, Rafi. It's the baby boomers versus the millennials, according to a Realtor.com article, in what is now known as the housing market's Hunger Games. Who do you think is winning?
Well, given that I can probably relate to a baby boomer more than a millennial.
You don't look like one, by the way.
I'm closer in age, thank you very much, to the baby boomer generation. I'm going to say that long term, the baby boomer will win, because I think that somebody who's been around a little longer has more experience and patience and is less likely to act on emotion and more likely to act on solid facts and data.
Ding, 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 ding. And you're right, sir. In today's cutthroat environment, with a severe shortage of homes and cash reigns supreme, which cohort do you think has the largest supplies of cash? But of course, you're right, the baby boomers. And they're winning the war hands down. We're talking about people that are born between 1946 and 1964. So let's not guess which year you were born in. But anyways, the percentage of millennials, on the other hand, who are born between 1981 and 1996, and are typically either first-time home buyers, have plummeted as they were confronted with, of course, record high prices, raging competition, influx of cash offers, and more importantly, high interest rates. So meanwhile, boomers are the wealthiest generation. They've been going out on a buying spree, especially during the pandemic. A lot of people traded up one home for the other. And in spite of increasing mortgage interest rates, they weren't worried about that per se, because the proceeds from one sale in many cases went to go fulfill the purchase of the other. And a lot of them were able to do that without a mortgage as well too. Remember, boomers became the largest home buying group, closing on approximately 39% of all U.S. homes, according to the National Association of Realtors as well too. And on the other hand, millennials who were successful in closing off homes fell to 28% from last year's 43% as well too. Many cases, they're also looking for the same type of property as well too. Some of the boomers wanted to downsize. Others just wanted to trade up to a nicer home, probably in the same size of the one that they're in. But to end this segment, although a lot of people have this misconception that prices are falling or expected to fall, I want to share with you a very interesting fact. The change in home prices from January 2022 to January 23 have actually vastly varied from one side of the country to the next. Here's a perfect example. Places like San Francisco, San Jose, down 10.3 and 10.5% respectively. And then on the other hand, places like Orlando and Miami have actually increased by 9.3 and 12%. So buyer, if you're thinking about waiting longer, now may be the time to go out and consider getting refinanced, because there's a lot, getting financed, because there's a lot of programs out there where you can buy down the rate and you can enter the market at a much lower rate than you can anticipate. If you have a question, please reach out to me on my website, which is realsensenow.com, or text the show at 321-339-1055. If you want to connect with me, all you have to do is visit any one of my social media platforms, which is Facebook, Instagram, and LinkedIn, by simply typing in my name, Dawood Bedrosian. And of course, as I say every single show, in spite of whether the real estate market trends upwardly or downwards, over a period of time, real estate always appreciates and trends upwardly over time. We'll catch you after the break. So we've been talking about the banking crisis, and we last spoke about the housing market Hunger Games between baby boomers and millennials, and it seems that baby boomers are clearly kicking the butts of all the millennials out there looking to jump into the housing market. A lot of people that are considering to buy a house feel the need to want to wait it out to see if the prices are going to further decrease. There are some experts that are anticipating that the housing prices are going to fall by about 15%, but I just found a source from Black Knight Home Price Index, which actually show pricing on the West Coast in cities like San Francisco and San Jose dropping by about 10.3%. And then on the other hand, the housing prices between January 2022 and January 23 actually increasing in places like Orlando and Miami by 9.3% and 12% respectively. The housing market in Florida has obviously continued to face challenges caused by rising mortgage rates, the decline in both single family and townhouse / condo sales as well too. But despite the challenges, the market has been has seen a significant increase in the end of month inventory levels in both categories. We've seen on the state of Florida on the whole an increase of over 134% when it comes to single family homes and an increase by 90% in townhomes and condos. And I know a lot of people may be worried about that, saying that there's going to be a lot of inventory in the market, which could obviously purport this idea of the pricing going down because now there's an additional supply of homes that may not meet the demand. But in fact, these levels are still short of the pre-pandemic levels and in most parts of Florida as well too. So I think when you start to understand the Florida market, you really need to take a bird's eye view and start to really focus in on a lot of sub-markets. When you think about real estate, when it comes to a purchaser, don't always think of it in terms of you, the buyer or the seller of a primary residence looking to trade a home. It's far greater than that. Florida is the second largest state by population, trailing after California, which means we have a massive economy that supports various aspects of our real estate industry. Whether you're an investor looking to buy a second property, rental properties, both long or short-term vacation rentals, whether you're looking at commercial real estate, medical real estate, industrial real estate, in a state where you can pretty much cover the majority of a state in a short driving distance between 3 to 5 hours and cater to that many people, that is the equivalent of having the economy of, I would probably say, more than a quarter to half of the countries of the world. And we have the luxury of doing that in the state that we're in. To add to that, there's a lot of people that want to move to our state because the pricing of our properties and the weather, the tax advantages that they have make it a lot more attractive. You have an aging baby boomer population that no longer wants to stay in frigid cold climate and want to relocate, even if it's for a short period of time, whether it's a snowbird or even for a longer period of time, and relocate here to take advantage of tax incentives or just simply enjoy a better and a cheaper cost of living, depending on where you are in Florida, of course. So it's no surprise that Zillow has ranked Tampa, Florida as the top real estate market in 2022. Miami is not far behind as well too. But overall, the Florida housing market is strong and is predicted to remain so over the next 5 years. And of course, if you're a seller, it's wonderful news because it implies that the property values are rising, as many reports are indicating, and there isn't much in terms of that selling competition. I believe that if the mortgage rates will dip towards the end of the year, I think we will be back to the kind of frenzy that we saw last year, maybe not so rampantly with that many multiple offer situations and stuff like that, but definitely a far greater interest, not only domestically and locally in our markets, but internationally as well, with more and more people that are coming to Florida to want to invest here. If you looked at the markets that crashed right after 2008, they were markets that consisted of Florida, Texas, Arizona, Las Vegas, California. Why? If you look geographically north, people in all of the states or countries in those areas north of these states traveled down because that was the preferred travel destination that they could go to. If you were in the Northeast or Midwest, you tend to want to invest in places like Florida on the East Coast. And if you are in the central part or in the mountain states of the United States, you would tend to look at places like Texas, Arizona, or Las Vegas just because they were a lot more affordable. Everybody would like to move to California and buy something there, but the taxes are really high and the prices were as well too. As a result of that, a lot of the people that forfeited those investments were the second, third homes, but a lot of the people were over leveraged. So we're talking about a completely different time, talking about a completely different seller, and we're talking about a different scenario, which I believe don't warrant a lot of these concerns as that were echoed in 2008. Yes, we are going through some trying times and mortgage rates are still rising and we still have an affordability issue that remain as our real estate market continues, especially into the near future. And what we're noticing is that whatever affordable homes are available, they're getting snapped up really fast. So if you want to buy in this market, maybe you might be thinking to yourself, now may not be the best time to buy. My advice to you, buyer, is get educated, because a lot of sellers are forced to, in some cases, reduce the prices of their homes. And although we're seeing this decrease in pricing, what we're also experiencing is a leveling off of an overinflated, super hot market. I don't think that we're going to experience a crash, but what I am noticing is that we are experiencing a correction, if you may. And in many cases, as I've indicated before, we're also seeing that the prices are increasing, but they're not increasing at the levels that we had experienced during the pandemic, which we saw appreciation levels of 20 to 30% as well too. Now, Florida is America's fastest growing state. I don't know if you knew that or not, Rafi. According to the recent census data, the Sunshine State added 400,000 people between July 2021 and July 2022. It was a growth of 1.9%, bringing the total population to, my surprise, over 22,244,000 and some change. That makes it the fastest growing state, even greater than Texas, which has the second largest population in the United States, only trailing after California. So I need to stand corrected from what I said earlier. We're the third largest state in terms of population, not the second. And according to experts, the national housing market for Florida is nowhere near a crash that occurred during the Great Depression. Hey, who would have thought I was psychic by saying that a few minutes ago as well too? And that's mostly in part due to what we've been talking about throughout the course of the show. Tighter lending laws coming from what we've learned from the financial crisis. Borrowers are in considerably better shape. And we've also seen an improvement in credit scores. Those who were smart enough to purchase prior to the pandemic are sitting really pretty right now with a lot of equity in their home. And it was for that very same reason where a lot of people ended up wanting to refinance or cash out refinance the equity in their home during the low mortgage interest rates that we experienced during the pandemic, to either go and refinance and go out and purchase a second home, an Airbnb, or find another source of rental income. And although the current situation is fairly complex, as we've talked about it, with a lot of shifts that we've been seeing in the market, whether it's tech layoffs or banking crisis with some of these banks shutting down, we are in a very, very, very different scenario. The Fed's pandemic actions fueled this housing boom, and we've been experiencing the settling of that this year. And this is really great news for buyers that are educated, that have great support around them, in order for them to go out and make purchases in various sectors. I'm working with a group of buyers right now that are taking advantage of, for example, multifamily. Why? Because a lot of the big institution money has also sat out and are not aggressively going out to take advantage of that. So there's a lot of room for those investors looking to pick up 20 units, 50 units, under 100 units, just over 100 units, because those multifamily home sizes are too small. There's other investors that want to jump in on a lifestyle play, get some passive income, and invest in one of the hottest vacation destination markets, probably in the world, Orlando, Florida. Buy a home that is far less than they could ever dream about buying, especially if you're considering larger cities like Chicago or New York or even Toronto. And they are jumping into this market. We're seeing a lot of New Yorkers that are moving to 3 cities in particular, which are obviously Orlando, Miami, and Tampa as well too. And all of these are indicators that there's a lot of money out there, there's a lot of cash money out there, and there's a lot of people that are taking advantage of our current market. So if you want to learn more about how to invest in our market today and enjoy passive appreciation, forced appreciation in order to grow your portfolio, because I keep telling you, owning real estate is the cheat code to your success, all you have to do is reach out to my website and shoot over an email with the questions at realsensenow.com, or catch me on any one of my social media platforms. That's Facebook, Instagram, or LinkedIn by just simply typing in my name, Dawood Bedrosian, and I'll be more than happy to have you listen in and be a part of our Real Sensors every Saturday from 11 to 12. Looking forward to catching you next week and hearing your questions throughout the week as well too.